There's a credible theory that says this whole stock market right now is being propped up by AI, and AI is being propped up by your insurance, which means if it fails, it will be our money that disappears. And here's exactly how it works. If you own a life insurance policy, an annuity, or a pension, there's a rule you may have never heard of called the State Guarantee Association. When a life insurance company fails, every other insurer in your state is forced to fund that loss. But in most states, they get that money back as a credit against their state premium taxes, which means the bailout isn't really paid by the industry. It's paid by the state, which means it's paid by you. A huge amount of AI debt has been stuffed into this structure. There is now more than $1 trillion of debt tied to artificial intelligence, debt used for data centers, GPUs, and power contracts. That's roughly 15% of the entire investment-grade bond market, more than the banking sector itself. And the laws meant to protect our retirement money don't apply here. About a week ago, on August 10th, 2026, the SEC clarified that these data center securitizations are not classified as asset-backed securities. So the disclosure rules and the risk retention rules put in place after 2008 to protect us do not apply. Life insurance companies now hold roughly $849 billion of private credit debt. That's about 42% of the entire private credit market. And in many cases, the private equity companies creating this AI debt are the same companies that own the insurers buying it, which means they are literally selling the debt to themselves. If it goes bad, the public covers it. And no one can tell us exactly how much AI debt is stuffed inside American life insurers, because a lot of it has been moved offshore to Bermuda, where disclosure requirements are minimal. Here's a real example. Meta wanted a data center called Hyperion in Louisiana. Cost? About $30 billion. Meta didn't want that debt on its books, so Meta put in 20% as equity, and asset manager Blue Owl put in the other 80%. Blue Owl didn't have $24 billion sitting around either, so they sold $27 billion of bonds that don't come due for over 20 years. The biggest buyer, Pimco, took $18 billion of them, managing money on behalf of pensions, endowments, and insurance companies. Meta gets its data center, Blue Owl gets its fee, and the actual risk, whether that building full of computers is still worth anything in 2050, gets transferred to a pension fund or an insurance company, which basically means it ends up with you. Take Apollo. Apollo owns a life insurance company called Athene. Apollo makes a loan to some company, and then Apollo needs someone to buy that loan. Who buys it? Athene, the insurer Apollo owns. $227 billion of Apollo's own deals sit inside Athene. Apollo makes money for shareholders by collecting fees. Athene's policyholders get a fixed return, no matter what. Two different groups. And it's not just Apollo. KKR owns Global Atlantic. Blackstone has stakes in several insurers. Brookfield owns American National. Roughly $700 billion sits under this same structure. If it blows up, it's not their money that disappears. It's the policyholders, then the guarantee fund, then the state, and then you. We got a preview of what stress on insurers can look like. Japan's 4 biggest life insurance companies, Nippon Life, Dai-ichi, Sumitomo, and Meiji Yasuda, are sitting on about $96 billion of unrealized losses on Japanese government bonds, and that number jumped 7% in just 3 months. But Japan actually has the good version of this problem. Their insurers own government bonds, which are safe, liquid, and priced every single day on the open market. American insurers own private loans that don't trade anywhere, worth whatever their own model says they're worth. According to the Financial Stability Oversight Council, U.S. life insurers ceded $2.4 trillion of reserves in 2024, with over $1.1 trillion of that flowing offshore. So here's the whole structure. Your premiums go into an insurance company owned by a private equity firm. That firm makes loans to AI data center projects, then sells those loans back to the insurance company it owns. The loans are worth whatever the model says. The rating comes from a company the industry pays. The liability gets moved offshore to Bermuda where we can't see it. And if it all goes bad, the state absorbs the loss, which means you do. It feels like we built a system after 2008 specifically so we could see this coming, and bit by bit, we've quietly recreated it. just with a few more steps. Time will tell what happens.